What is going on YouTube? Hayden back. The S&P 500 has finally broken its 7-week free fall, almost a 17% drop and its worst stretch since the dot-com bubble more than 2 decades ago. Now this could mean we have finally found the bottom in the market, but some analysts still believe this is only a relief rally and a recession is still on its way. Now the past 2 months have been a rough ride for almost anyone who has pretty much money in the stock market, and my portfolio to this day is still roughly down 17% from its high. But this might actually be the break in the market that we've been so desperately waiting for. And it's not that often where we see the S&P 500 fall for 7 weeks straight in a row. Now this is the 4th time we've seen such a streak since 1928. The prior 3 scenarios occurred in 1970, 1980, and even in 2001. Interestingly, all 4 declines concluded either in March or May. Even though we can continue to slide lower this year, seeing a 7-week correction is usually a sign that we are close to the end. Now all 3 previous corrections of 7 weeks or more managed to recover higher 4 weeks later, 3 months later, 6 months later, and even a year later, which is obviously a good sign. Now anything is possible and we may continue to drop, but at least we could also be coming up on a short-term or maybe even a long-term bottom for the market. However, the one thing I'm still confident in is smashing the like button for the YouTube algorithm, as well as subscribing so YouTube and I know that you want to see more content like this. In 2018, we saw something happen to the S&P 500 that's very similar to today. During this time, there was a lot of tension between the US and China, mainly caused by President Trump's trade war. We actually saw a slowdown in global economic growth, and there was a huge concern that the Federal Reserve was raising interest rates way too quickly. In 2018, Jerome Powell issued 4 interest rate hikes, causing investors to fear that the rates could trigger a recession, and this also sounds a lot like today, right? Do you see the correlation? Now, stocks were relatively high at the beginning of 2018, and the Dow Jones Industrial Average Index had tripled since the low of the Great Recession. Now, I'd argue that the market, especially tech stocks specifically, were only inflated in their earnings in 2018, just inflated. Now, stocks just last year in 2021 were actually relatively high as well, very similar to 2018. And the bull run allowed tech giants to become really overinflated in earnings due to mega stimulus and borrowing. When interest rates are increased by the Federal Reserve, big tech gets hit hard, lowering their future earnings evaluation and causing major swings in the S&P 500. The top 5 or 10 tech companies make a big portion of the S&P 500, which means when they are performing well, the whole S&P 500 can pump. And this also means that if tech giants negatively perform, then the entire S&P 500 can get dragged down with them. What's interesting is during the 2018 trade war, the S&P 500 closed 19.8% down from its peak, leaving it just a smidgen above the 20% bear market line. Now, on the day after Christmas, it dropped briefly into a bear market territory, only to rally by the end of the day, exactly like what we experienced a few days ago here in 2022. Now, the market then went on to gain more than 44% until its next big crash early in the pandemic in February of 2020, if not maybe March of 2020. Now, what's crazy is we could see the same thing happen this year. It's only been really 2 years since we saw the last, major crash, not just a bear market, which means statistically it's unlikely that we would see another 30% or more crash for a long time. Just remember, guys, the stock market is not the economy. Economic indicators are backwards looking, and they tell us what the unemployment rate was in the last few weeks or even few months. The stock market, on the other hand, is forward looking, and investors are always trying to guess what is going to happen next and how it might affect a company and its profitability. So even if today's economy is still good based off prior indicators, it doesn't necessarily mean that the stock market will react positively in the future. Now, if the economy is currently good today but is expected to get worse in the future, that's what will drive us lower in price. The only problem is we still have a lot of unresolved issues in today's economy, unlike back in 2018, giving us a worse outlook for the rest of the year. This is where the second part of the story comes into play. Now, you see, we still have the Feds raising interest rates, which caused I bonds to explode to a record high of 9.62% interest rate. And for those that don't know what I bonds are, it's basically a bond backed by the US Treasury, which has very little risk in regards to investing in them. I bonds also increase in price to match and beat the inflation levels, which is why this is good for investors, but not necessarily a good look for the economy. Now, we are still seeing new COVID outbreaks and now even a new virus called the monkeypox. And we are still seeing oil and gas prices surge through the roof, with some places even seeing close to $10 a gallon. Even the president admits it's too too high, allowing the sale of a 15% ethanol gasoline blend between June 1st, which already started, and September 15th in the hopes to ease the elevated fuel prices. Now, even if this works to reduce gas prices by maybe at most 10 cents per gallon, and because I'm super into cars, I automatically know what this is going to cause, especially because I own a car that I could tune for E85 or ethanol-based gas. And what you normally see with ethanol, which I feel like a lot of people don't understand, is that ethanol burns much faster than gasoline, meaning that not only will you be filling up much more frequently, but it's also a much bigger producer of pollution. Now, on top of that, we still have a housing and a rental market shortage, and there is still a war going on with Russia and Ukraine, and now we are starting to see the beginning of major layoffs, especially for tech and crypto companies. Roughly 17,000 workers got laid off from 71 tech startups around the world just last month in May, the highest number since the early panic of the pandemic in May of 2020. Now, Coinbase will also be implementing a hiring freeze, and it will also retract existing offers to new hires. Robinhood is even cutting 9% of its staff, and even Gemini, another massive crypto exchange, is cutting 10% of its employees. And this is just within the crypto industry. Tech is even worse. Meta, Twitter, Tesla, and even Microsoft have paused hiring altogether. Peloton has laid off nearly 4,000 people, Carvana fired 2,500 people, and even Netflix has begun to lay off employees. So with all that being said, it's really hard to believe that we've hit the bottom in the market or are close to it. And this is most likely just a relief rally that we are experiencing, especially since we have yet to find solutions to all these major economic problems. Now, when major companies start to lay off employees, it's a telltale sign that our economy is hurting. Corporate likes certainty that the economy will do better than where it is today, but with quantitative tightening and higher interest rates in the forecast, corporate will begin to cut costs, starting with employees, and wait out these bad times. Now, the only thing we as investors can do is just be patient, build an emergency fund, pay off those high interest rates as well as those flexible interest rates, as well as let the feds just do their job and slow down inflation. And currently, the feds have no intention of slowing down their QT either. On May 3rd of last month, the feds increased rates by 0.5% or 50 basis points, the most they have ever done in 20 years, and they have no intent on slowing down. Most analysts even believe they plan on doing the same thing in June of this month as well as July to further slow down consumer demand and inflation. We will also see the feds begin to unwind assets on its $9 trillion balance sheet this month at nearly twice the pace it did in previous quantitative tightening cycles, or QT for short. Come September of this year, the Fed will be cutting $95 billion a month from its holdings, split between $60 billion of treasuries and $35 billion of MBS, or mortgage-backed securities. And this is roughly double the maximum pace of $50 billion a month targeted in the 2017-2019 cycle that I explained just a few moments ago. Now, in the last cycle back in 2018, it took a full year for the Fed to reach the maximum reduction rate of $50 billion a month, which could be a factor as to why we recovered so nicely after. Now, it started with $10 billion a month and then increased that by $10 billion a quarter until it reached its maximum rate in the fall of 2018. Unfortunately, this time we're going to be going from 0 to $95 billion in the space of just 3 months, with only one initial step before moving to the maximum reduction pace. This month, it will start the process of $47.5 billion a month for the first 3 months. And unfortunately, this leaves the middle class once again stuck in the middle. With the feds raising overnight bank loan rates, the banks pass on that fee to their prime rates, which we as consumers have to deal with. This means mortgage rates, small business loans, credit card rates, and even car loans will not only be more difficult to obtain from banks, but we'll also see the interest rate skyrocket on those loans. Gen Z and millennials seem to be getting hit the hardest. 2/3 of American workers say their salaries are not keeping pace with inflation, and the percentage of employees considering quitting their job is at a 4-year high. 60% of workers say inflation has outpaced any salary gains they've made in the past 12 months, while 19% say increases in their salary have about matched inflation, and about 13% say that their salaries actually increased more than inflation. Now, as more American workers at multiple income levels give voice to a frustration that the economic data has been signaling throughout this year, that price gains continue to outpace wage gains, and the squeeze is particularly high among middle income workers. And those people that actually have between $50,000 and maybe $150,000 are more likely than high income and even low income groups to say that that their salary has not yet kept up with inflation. What's even worse is people between the ages of 18 and 40 are at least 60 days past due on their auto loans in the first quarter of 2022. Now, Gen Z, which includes those born in 1995 and after, have a past due date of 2.21% compared with 1.75% before the pandemic. Millennials, those born between 1980 and 1994, have also fallen behind on car loans at a rate of 2.14% compared to 1.66% before the pandemic as well. In response, the government is warning Americans against the possible wave of car repossessions, as data suggests we are currently in a car recession. Since the new US car sales are rapidly declining due to the over-sticker prices and low inventories, there has become such a massive resale bump in used car prices that it makes it really tempting for lenders to repossess a car early on defaults and resell it quickly. Now, for decades, the math behind used car loans has stayed the same. And when borrowers kind of fall behind on car payments, lenders gave them a grace period to catch up on payments. Now, the reason lenders did this is because it raised more money in the long run than if the lender actually seized the car and resold it. Unfortunately, in today's market, that's taken a complete opposite approach, and it actually is more cost effective to repossess those cars. Now, when you combine all these economic issues together, the most likely result is a sluggish second quarter GDP, especially since consumer demand makes up 2/3 of our GDP. And also, this will inevitably cause a recession if we see second quarter GDP in a negative. And that's going to most likely then send the stock market and S&P 500 even lower than where we are today. So Hayden, what am I supposed to do? How do I invest in markets like this? Do I throw my money into the market? Do I take my money out in case, the prices dip lower? Do I quit my job? Do I find a different job? What is it that you're doing? Now, these are all great questions, but really my plan is just to sit tight and ride this out while continuing to invest in index funds at a more aggressive pace than I've ever done before. This is actually the most aggressive I've been since the end of March of 2020. March of 2020 was kind of that onslaught and correction back during the pandemic, and that's when I really started to aggressively buy, when we saw like a 34% drop, and we're kind of seeing a similar thing happen now, which is why I'm so aggressive on putting my money into major index funds. Now, like I've said in all the other episodes that I have on this channel, at some point the market is going to bottom, as it always has, and it will recover like history has shown, and I want to make sure that I bought while everyone was fearful. So guys, that about wraps up today's episode. Make sure to subscribe if you haven't already, turn on post notifications, smash the like button for the YouTube algorithm, and I'll see you guys in the next video. Peace.